Hey everybody, welcome back to the channel. I'm Doug, the retirement guy, and I got a question from, it was a couple different YouTubers, and then it actually came finally from one Patreon supporter. And the question is this: is QQQI still the best Nasdaq-100 income ETF for retirement? And I questioned it because we've done a lot of different videos about these, and they were just talking to me about their whole situation, their portfolio, everything about it. And his wife was a little nervous that she saw a couple bad presses about QQQI, and she was nervous about it. So she wanted to ask. They're part of our little membership that we get to talk every for an hour every month. And so I said, okay, let's break this down. Income today, growth for tomorrow. The structure is built for that middle ground. So right off the bat, I'm thinking, yeah, QQQI is very good, but what is it that we're missing? And the goal of all this is to get a monthly paycheck to pay your house bills. You're looking for growth from the Nasdaq-100, and you want to protect your retirement nest egg. So let's break this all down for them, show them what we talked about, give them the idea behind everything to see, does it really fit that this is still the best package around? We got an important disclaimer. This content is for educational and entertainment purposes only. It's not financial advice. If you need that, always talk to a professional, and past performances do not guarantee future results. Hey, before we get too deep into it, I got to do a big thank you to all of you who have bought the 11-ounce cup and now our Big Daddy, the 15-ouncer. Thank you so much. Remember, all of this helps support the channel. We don't do advertisers. We don't do affiliates. We don't do any of that. We pretty much do this all for the good of our heart. And what helps support the channel is our Patreon and our YouTube members and the selling of the mugs and so on. Thank you so much. If you want to get one of these, it's real simple. You can do the QR code on the side, or you can go in the links down below and click and order it. And I am so proud to announce we have just introduced one of the newest products is our 40-ounce travel mug. And I hate to tell you guys, this all came from, I took my cup out to my truck, got in the truck, dropped it, shattered it all in the driveway. My favorite Doug the Retirement mug is gone. And I said, we got to do something. I need something for my truck. And we came up with this, and I'm excited about it. So these have been on order. They're showing up, I believe, just a day or two. But by the time this video gets out there, we'll have them. So get on order one early, do the same thing, QR code, or hit the link, and you'll see all the stuff that we offer. So here's the question that came into it, the $1 million dilemma. After years of saving and doing all that, the portfolio really has a different job now. During your work years, it's about accumulating the growth. Accumulate, accumulate, accumulate. Now that you're starting into retirement or you're into retirement, you need to create income to pay your bills, to preserve your growth. For retirement, it's probably going to last you 25 to 30 years. And this is what they were talking about. She was really getting nervous. They were just starting to get into, they're planning on getting into retirement. He's leaving his job closer to the end of the year. And she's like, I'm trying to put this together. Still, is this right? They got about $1 million portfolio. And I said, you're going to be fine. Let's break it down. Income for today. So we want to figure out how to generate income to pay your cost of living. And then we're going to find some growth out of it to make sure we're staying ahead of inflation and refilling your coffee pots. So two extreme pieces and the yield trap that people run into. Distribution rate is not the same as total investment return. I got to keep clarifying that. So many people argue with me across the board on this. Yield is not income, and income is not yield only. A traditional Nasdaq-100 growth ETF, something like QQQ, it has strong growth exposure, it's relative small dividend income, and it may require selling shares for cash. So selling can always be harder after, a 20 or 25 or 30% decline in the fund. I said, so this is what you run into when you're building for growth. Now it's time to build for income. So I told her, I said, the aggressive option income ETFs like QQQI, you may advertise at 20, 30, 40% distribution rates. Now I know QQQI doesn't do that, but if they do, large cash payments can be very, very appealing. But if you're losing share price, if the fund is dropping, you're getting your own money back. You're not really getting those true yields. That's why total return means everything that we're dealing with. Your income portfolio really has two jobs. And this is what I really wanted to explain to her. It really has two jobs. Job number one is to provide current income. This is the income you need. It's like your paycheck. You need to have that current income to pay your bills, to retire comfortably, to do your income spending. Job two is preserve your capital and grow your capital. Okay? I'm not saying that we're in the growth of that we got to see 10, 20% growth rates. What I'm saying is we still have to grow above inflation. We have to grow continually above so long term can hold up. And this is why I always say QQQI is the middle ground. It seeks highly monthly income in a very tax efficient manner while maintaining the potential for equity appreciation. So I told her and explained to her that the three bucket retirement system, and that is bucket one is your foundation, bucket two is your growth, and bucket three is all about income. We keep it simple, balanced, and we build it for life. So whenever I explained that, she says, I saw the video, I understand it. She was happy about it, and I'm like, okay. So what we're really looking at here is your foundation, your growth, in which we dialed in, made sure she was right. And then we said your income. This is what we're talking about, is your income bucket. So QQQI at a glance, to give you an idea, this fund advertises a distribution rate of about 14.05%. Now, of course, remember, yields can change as the stock market goes up, stock market goes down. And the simplest way to tell you, all it's doing is taking the distributions that's been paid. And if the price of the fund goes up, the yield's going to go down. And if the price of the fund goes down, the yield's going to go up. So this is just it's a moving target, and it's just a number to work from, but 14.05%. Pays out monthly. The carrying cost of 0.68 is the management fee. That's what they get paid to do what they do, and what you're paying that is a long period of time. Now that comes out of that distribution, let's say it this way. That distribution rate already has that management fee already all put together. But remember, the distribution is not total return. And of course, as I said earlier, this is not guaranteed. You're not guaranteed this money. That's why you got to buy a high quality piece. Even those aren't guaranteed, but we have it so that we can be comfortable in long term. Now, how QQQI generates its income, because this is very critical. They do a Nasdaq-100 exposure. So they own a portfolio designed to provide the exposure of the Nasdaq-100 companies. And that's very critical. Number two is they sell index call options. Not on the funds they own. What they actually do is they buy another index, which is built on the Nasdaq-100. It's the NDX index. They sell covered calls on that index, and that's where they receive their premiums from. So your growth package comes from holding the Nasdaq-100 portfolio, and selling those options creates the income across the board. Now it's a covered call, basically we call it covered call bargain. Income today in exchange for some potential appreciation tomorrow. And that's one thing everyone has to understand, that if you're going to get heavy yield, you're going to give up growth and that appreciation. If you want heavy appreciation, you're going to give up some yield or some growth on that side. So the call spread difference, using an option premium to potentially reopen the upside participation is what we're trying to do. Let me explain to you what a traditional cover call ETF does. And the simplest way I can explain this is, think about if you rented out your house. You're living in the bottom portion of the house. You're renting out the upside, the future upside, or the upstairs of your house. You rent that out. Well, when you rent it out, you're not expecting to go up there. You're not expecting to use it because you rented it out. That's what a traditional cover call does. It caps your house. It caps the upside. You cannot go up there because you've rented it out. Now, what happens on a NEOS, the QQQI side of it? What they do is they sell a call, so they get that income. And what they do is they buy further out of the money calls. They're buying things, they're buying someone else's call and turning around and reselling it. Okay, this may reopen some of the upside participation, but you remember they also have the entire fund open. So the trade-off, slightly less income today, may preserve more growth for tomorrow. And that's what makes theirs so strong. So what could the monthly income look like? Well, just doing some simple math here, using the numbers that we have. If you had $100,000 invested and you got a 14.05% distribution rate, your monthly equivalent is about $1,171. That's pretty darn good. Okay, so that's basically the 100,000 times the 14.5, which is $14,050. Divide that by 12, gives you an estimate about how much you're going to get per month. Add a zero in front of that, add a zero at the end. Now you're talking about $10,000 a month if you're doing $1 million. That's why these numbers become so dramatic and so huge. Now, I don't suggest you do everything in the QQQI. That's why we do the 3 bucket. That's why we have core, we have satellites. There's a lot of information behind the scenes for all that. And remember, this illustration is just an illustration. This is not guaranteed money. This is not guaranteed anything at all. This is just how math works and how the percentages work and how it works. The paycheck that you're generating is that 14% divided by 12 to give you a monthly investment number. Now, taxes. This is the biggest thing I tell everybody is when you're dealing with this, it's not how much money you make, it's how much money you keep. And this is why I think QQQI is still the best across the board, my opinion, with most of the people I talk to. QQQI NEOS does such a great side of things using the tax-aware strategy. First, it uses the NDX index options. Okay, those options that are qualify for section what we call 1256 contracts. Now you'll ask, what is 1256 contracts? What it takes is the distribution is set up in saying it's 60% long-term federal tax treatment and 40% short-term federal tax treatment. So right off the bat, they're cutting your taxes as low as possible because long-term capital gains can be 0% taxed, 15% taxed, or 20% taxed. Okay? So they do this right off the bat across the board. After that, they do so many more things. They do tax harvesting, which is they may have a fund that's gone down. They may be a negative of the fund. They'll sell it off. They get to deduct that from the tax side of it and buy it. They could buy it back immediately. They do the tax loss harvesting. So there's huge opportunities there. They also use ROC, return of capital. Now, not a lot of people think about that, but QQQI is using that as a huge additional. So it's almost like the triple threat into the tax awareness plan. Now, why do I always talk about taxes? Well, again, as I said, this is about how much money you keep versus how much money you make. So we want to keep as much money as we possibly can. The other thing is, somewhere down the line, you will walk away from your Roth IRAs or your regular traditional IRAs, and you'll have a brokerage fund. Almost every retiree I talk to has a brokerage fund, and this is where this one fits the best and does the best job in brokerage funds. Now, I'm not saying you can't use it in an IRA, and I'm saying you can't use it in a Roth IRA or anything like that. It's still okay to do. You just the tax side of it is totally different in those funds. Not they change anything. It's the rules that the government puts into place. So the right way to compare Nasdaq income ETFs, I went through this that gave them the information. Now we do this on the channel all the time, so it's always love training people and helping people out. And here's where I come back with. Comparing the whole retirement income job is not about a yield alone. The first thing you want to do is going to be income. Okay, how much income are you receiving? Now, I suggest this in two different ways, and that is one, you can look at percentages because that's a mathematical number, is all that is, or you can look at the dollars that you're collecting. I've seen funds where, the yield may be higher, but you're collecting less money. And it's really funny how I tell that to people, and they're like, what? They take a serious look at it and say, you're right. I can collect more money with a lower yield than I can with a higher yield. The other thing you want to do is take a look at the growth. How much growth am I retaining? And one of the things that you get between it, and this is where the number 3, and that's why it's a bigger picture, bigger square, is because it's so important. Number 3 is actually a total of income plus growth. Okay? That gives you your total return. And I keep it so simple for people to understand that if you take your income plus your growth, that'll give you your total return around, I'll call it very close to the cup side of things. So if your income says it's 10% and you got a growth of 5%, your total return is probably going to be somewhere in that 14, 15% category. But here's the thing. If your income is 15% and your growth is -5, you're not getting 15%, you're only getting 10. That's your total return. That's why when you look at total return and you look at your yield number and you're like, why is the total return less than the income? There's a problem with the fund. It's where you come into with NAV erosion type stuff that we start talking about. So you got to look at your total return, what's happening to your original capital. You got to take a look at the distribution risks. What risk created by that distribution, by the strategy? That's why we talk about the strategies all the time. And then really, how much money do I get to keep? Which is the after the taxes results. How are they handling it? So you have to keep watching the share price, the total return, the NAV stability, the risk and market behavior. All of these things you have to continue to focus on. Now, QQQI don't just finish the first everywhere. Its potential strength is balanced across all these different categories. That's why I start saying, hey, this is a better deal or not. Let me show you some of the real quick here. We're not going to go deep comparison, but we did this in the phone call with her. But I wanted to do this. QQQI to JEPQ. Two totally different structures. They do two totally different types of jobs. QQQI uses that index trading with those call options. JEPQ uses ELNs, which are the quality income structure. They're both going after the Nasdaq-100. Well, JEPQ may appeal to investors who prefer the JP Morgan's active trading selection and lower management fees, but with that you're getting lower income. You're not getting the growth as much as you're looking for. When we like QQQI to QDTE, well, there's some exciting, interesting things here. QDTE is paying weekly payments. Okay, it's using 0 DTE or 0 days to trade options. It seeks income each trading day by selling. It's out of the money calls expire that day. And they use a synthetic long exposure to the Nasdaq-100. So they do things totally different. And then people will jump on this because I'm getting it payment weekly versus monthly. Well, there's so much more going on, and you have a synthetic, which means they're not really owning the Nasdaq-100. They're playing, synthetically. They're building around it. So it's a totally different behavior again, and it doesn't outperform what QQQI actually does. Now, here's the one that really starts the big play. And I'll tell you, I've done the videos on this over and over. And if you haven't seen it, look in the past, you'll see my history on this. But income versus growth. QQQI has a larger monthly distribution and it retains a reasonable growth opportunity, while GPIQ has more growth participation with a lower distribution rate than QQQI. And I've talked about this on the show so many times. If you want income, QQQI is your baby. If you want growth, GPIQ. These two work very, very well together, but understanding their roles, income and growth. Then we get into this one, QQQI and XQQI standard or boosted. The more income potential also means more amplified downside. What that X really means, and that is really, it's leverage, okay? They're trying to give you more exposure to the Nasdaq-100, exposure plus additional income option exposure. They're approximately doing 150% of the exposure of QQQI's underlying approach. Okay, so the monthly distributions are going to be pretty much 19 to 23%. So if you were just looking at yields, you're right. XQQI is probably the best choice to do. But you have higher management fees, you have less track history, so you don't have as much history to go by. And because you're doing that leverage is that double-edged sword. And that goes to the good and to the bad. So it will raise this thing up to 19 to 23%. But man, if the market drops, you're going to come down twice as hard. This is what the difference comes into. Carrying is less than QQI. These are all the things that they brought up saying, well, we thought about this one, they thought about this one. And I'm telling them straight out, XQQI is not simply a higher paying version of QQQI. It's more aggressive and generally prefers the standard. QQQI is your core of retirement. Now, I'm not saying you don't have a place for XQQI or any of the other funds, but when you're core, this is where you want to be. Now, there are drawbacks. QQQI does have drawbacks as the middle ground income strategy still carries some meaningful trade-offs. The management fee. You got to pay management fee 0.68%, but I got to put it out there. That is a drawback to it. Return of capital. I told you they use that. This can be a double-edged sword too, but I believe NEOS uses it in the most proper way. But it's not the only tax burden that they use. They use the tax harvesting, the 1256 contracts. So the little bit that they will use can help just polish off everything up top. Now, 3, this is where we're really getting to it, the upside limitations. Even with them having their open portfolio, there are still going to be some lags in the gain and the growth of a fund because of the call options. Now, there is no major downside shield. Okay, there's nothing stopping this from dropping and dropping hard. So these are the things you have to look at in the particular fund. So why does QQQI really stand out? And that's real simple. It's the balanced scorecard, not the trophy pendulum. It's the balance that we look at. It stands out because of the high monthly distributions, that meaningful NASDAQ exposure, the purchase calls may preserve that more of the upside potential. Your tax packages are huge. It's not a boosted product, so what you're seeing is actual hardcore earned numbers. There's no daily zero DTE structure like QDTE to work from. So what is the not solve? It's not the highest yielder out there. I guarantee you that. It's not the highest. It does not capture the full QQQ upside. It's not the cheapest in town, and it does not provide significant downside protection. But when you do the balancing effect in a retirement fund, more balance and more growth, more packaging is always coming into QQQI's favor every time I do the comparisons. So where would you fit QQQI in the retirement buckets as we talked about? Well, right off the bat, it goes in the income bucket. It's a core piece of the income bucket. I always say in a core bucket, you need to have a NASDAQ income fund. You need the S&P 500 fund. You need the small cap funds. You need all 3 funds in that one bucket and work them off accordingly. And I think QQQI is a great candidate to be that core piece of the NASDAQ exposure. And with that, you're going to get you have a complete retirement plan. You're going to have income. You're going to have things that you can work with across the board. Let me know what you think about that. Do you think it should be in the income bucket? And do you think QQQI is still number 1? Leave me a comment down below. If you think there's one better, I'd love to hear from you. So my final verdict, is QQQ still one of the best? Well, I'm going to answer it this way. Maximum growth only? Probably not. It's a traditional Nasdaq-100 ETF. It just works cleaner. So we're not always on the growth. Is it the most possible largest distribution? Absolutely not. We have other funds out there that will create more income. But when we put this all together, that total return I talked to you about, The middle ground retirement income, QQQI, continues to be the most appealing case that they are the balanced approach. Strong tax program, strong income, and growth on top of it. I just think it's number one. I think this is a long-term hold, long-term play. Let me know what you think. Also, don't forget about our new cups. We've already gotten quite a few already pre-ordered. Don't be afraid. Hit that QR code, hit that link down below. Order your cup today, and we're ready to go and ship them out for you.